Rick Bensignor. Today is Tuesday, November 17th, and welcome to this week's In the Know Trader Show. We've got a lot on tap to cover this week, and we're going to start off with taking a look at our trader education portion. I want to talk to you about using major index ETFs like SPDRs and QQQs and IWM, for instance, to hedge your portfolios and what that means, because I think a lot of you don't know what it is or how you can actually use them more than simply speculative trading tools. In our market overview section, we'll take a look at a long-term chart of the S&P. We'll look at growth versus value, because that's been in the news since a week ago Monday, when Pfizer's news hit the tape, and all of a sudden you saw a rotation into value names. And we'll take a look at the 10-year U.S. Treasury market. And then we'll look at actual large cap value names. In other words, the top component names in the IVE ETF. So that includes Berkshire, United Health, Verizon, J&J, Telephone, Pfizer, Walmart, Bank of America, Cisco, JP Morgan, Procter & Gamble, and Exxon. That's a dozen names. We'll try to get to as many of them as we can. Sign up for my weekly ETF report that comes out Wednesdays, the Tactical Trader Report, or the new 7-Eleven monthly sector report, which aims to beat the S&P over time by being in no more than 7 of the 11 macro SP SPDR ETFs. Sign up for all that and find out more at inthenowtrader.com. And of course, my email address is rick@inthenowtrader. All right, so let's start our trader education portion and talk about using major index ETFs. So most of us use SPDRs to simply trade if we're bullish or bearish the S&P. And by and large, most people are going to buy the SPDRs and either hold on to them in their accounts, or occasionally they'll sell them out. And I would say more often than not, most people sell them out when the market has sold off a fair amount and they get scared that the market's going to sell off further. And the same thing for the QQQ, which is the NASDAQ 100 tracking ETF, or the Russell 2000 tracking ETF, which is IWM. These are three of the most popular traded stocks every single day. Obviously, they're not individual corporate issues, they're ETFs, but they are very, very heavily traded. The SPDR, in fact, is traded more than any other security there is, by a multiple probably of 10 on each day. So let's just use SPDRs as our example. So this tracks the S&P. Currently, the cash S&P is about 36.15, and the SPDRs are trading at 360 3/4. So they're not exactly lined up because of the influence of interest rates and the fact that dividends are a part of, when you are long a SPDR, you actually get the dividend payment. When you're the SPX is just a cash index, you don't receive dividends, and interest rates don't factor into the pricing of it. So you're always going to see the price of the SPDR be approximately 1/10 the size of the cash S&P, minus a little bit. And so if you buy one SPDR, you're buying 100, no, actually that's one share. It's worth $360 right now and 70 cents. If you buy 100 shares of SPDRs, you're buying $36,000 worth of stock. And what's more important here is not about buying it, but I want to talk to you about actually hedging your own portfolio. Yes, you, Mr. Individual or Miss Individual portfolio trader / investor, can do just like the big people on Wall Street can do. You can hedge your portfolio. And why would you want to do that? Well, let's say you have a taxable account that you have an assortment of stocks. In total, they don't have to exactly match the performance of the S&P each year, but let's say you have a broadly diversified portfolio that somewhat loosely tracks what the market does. So on a big up day, your portfolio gains in value. On a big down day, your portfolio loses in value. And it pretty much goes in the direction and somewhat similar percentage change on a day-by-day basis of what the S&P does. And let's say you have that in a taxable account, but you get to a point in the market that you think the market's going to come off and maybe even come off hard. Well, you have a choice of A, doing nothing and hoping that the market sells off and eventually recovers, B, selling out of your stocks or a certain percentage of your stocks and therefore incurring certain tax liabilities, which can be a combination of long-term and short-term capital gains, depending upon how long you've held the actual stocks. Or choice number 3 is to use the spiders as a hedging vehicle. And what you can do is, for every spider, for every one share of spider that you sell, you're selling the equivalent right now of about $361 worth of stock. So if you sold 100 spiders, it would be $36,000 worth of stock. And if you have a $100,000 portfolio and you think the S&P is getting to a point where it could easily tire and pull back from, you might want to sell some spiders against the value of your portfolio. And here's what that does. Let's say you short S&Ps. I'm going to use round numbers here, even though it's trading 361 right now. I'll use it as if it was trading 360, which it was just earlier today. So by selling 100 shares of spiders, you have the ability to hedge $36,000 worth of your portfolio at current prices. So if you had a $100,000 portfolio, roughly a third of it, you're essentially taking off without incurring the tax liability of selling out of each and every one of those stocks that you were going to. So if you're short spiders, what you're doing is eliminating the upside performance on roughly a third of your portfolio. So if the market kept going higher, of course, your portfolio that replicates to some degree, we said the S&P, will keep making money. And the spiders that you've sold at $360 per share are going to lose money because the spiders will move up in value as the S&P moves higher. So you're not losing money, you're giving up money that you would have made if you hadn't shorted the spiders. So you've hedged a certain portion, in this case roughly a third of your portfolio's exposure to the upside, and you will not capture that. You'll only capture 2/3 of the market moving higher because your short spider position will be losing virtually exactly what your stock portfolio is making. So you're long in one place and you're short in another place. Those two offset each other, but you only sold a third of your portfolio's value. But let's say you were right. Your market analysis was correct and the market comes off. Your whole portfolio of stocks loses money, just like it does when the S&P sells off. But by being short spiders, a third of your portfolio is hedged, and you'll actually make, by being short the spiders, the same loss, or essentially the same loss, depending on how exactly correlated your portfolio is to the S&P. But you'll offset a loss of approximately a third of your portfolio. So instead of losing if your account was worth $100,000 and the market sold off 10%, your portfolio is only worth $90,000. If you sold a third of your portfolio of value in spiders and the market sold off 10%, now you've saved $3,300 worth of the decline. Your portfolio is only going to lose $6,600. So you'd be up at $93,400 roughly. In other words, a third of the loss you hedged out. So I bring this up because there are going to be times where the market reaches certain levels, and unless you are a pure long-term investor, in which case I'm guessing you're probably not listening to this show because this is more of a trading-oriented type of show, and ideas that we put out in the Tactical Trader Report is more of a tactical trading and short and sometimes medium-term trading, but it's not meant for investing per se. Then you're the type of person who generally likes to buy and sell stocks and likes to buy and sell ETFs. But instead of thinking of the cues and the spiders and the IWM simply as trading vehicles to speculate on, you can also use them as real hedging devices for your own portfolio. So depending, even if you had a $10,000 portfolio, if you thought the market was coming off, you could sell a few spiders. Selling 3 spiders hedges 10% of your portfolio. So if you had $10,000 with spiders trading at 360, 3 of them, hedges about $1,080 worth. If you wanted to hedge 20%, you could sell something like 5 to 6 spiders. So depending upon, the point here is, I think so many people don't realize the practicality of these ETFs and what they can do for you in your trading when you get to a point that you actually want to and think that the market's going to come off. Instead of selling out of your stocks, you can simply short spiders. Some of you have said to me in emails, I can't short, or I don't want to short. Well, in this case, you're lucky because there happens to be a fairly, for spiders and QQQs, I'm not sure for the Russell, but there's an ETF, the ticker is SH. It's a kind of mnemonic for short, and it's the inverse of the spiders. So by buying SH, you're actually going to make money when the S&P goes down. It's one of these inverse ETFs, and if the S&P goes up, you're going to lose money. But there is a way, essentially, if you don't want to short or don't understand shorting, I suggest you should learn how to short and understand what it means. But there is a way that you can actually buy an ETF that will make money as the value of the S&P goes down. You can do the same with the QQQ. If I remember correctly, the ticker is P like Peter, S like Sally, Q like Queen, PSQ. That is a direct one-to-one relationship to the NASDAQ 100. It's just inverse. So if you buy it, it will make money as the Qs or the NASDAQ 100 goes down in value. Again, I'm not sure if there's one for the Russell. But I just think, to me, it was worth spending half the show on this for you guys to understand. There are easy ways to hedge your portfolio. You give up opportunity cost. You don't actually lose money. You simply don't make money on your underlying portfolio. And if your underlying portfolio is close to tracking the S&P, you'll lose on your hedge what your stocks are actually making if the market kept going higher. So if you have a mistimed hedge and you reduce your exposure by shorting spiders or Qs or IWM, you'll lose money on the hedge side, but you'll make it on the stocks you actually have in your portfolio. So at some point, you need to cover your hedge. And if the market goes down, you've covered your hedge at a better price than you shorted, at a lower price than you shorted them at. So your short made money, but the value for your portfolio went down. And essentially, it's very, very, they should be very similar to offset each other. So shorting spiders or shorting Qs or shorting IWM against a portfolio that has large exposure to any one of those 3 major ETFs is the value of being able to use these ETFs for more than just simple, oh, let's buy something, let's buy XHB because you think housing prices are going up. Well, if you had a portfolio that was significantly tied to housing, then you can short XHB against your portfolio, and you'd have a very similar type of offset. So whether it's XHB, XLF for financials, if you have a portfolio that's deeply, deeply related to the banks and the brokerage firms, and that's the bulk of your portfolio, then you can sell XLF against it, and so on. So it doesn't have to be the spiders, but I generally am thinking in big macro terms. When you think the market may potentially come off from a level, you can sell some spiders, etc. So that's today's trader education. All right, let's move on to our market overview. When we start that, we usually start first by looking at the week-over-week comparison in the S&P sectors to each other. So on the right-hand side here, you'll see there are 5 dots, 2 red and 3 green. The green ones outperformed by more than 1% relative to last week. So in other words, industrials picked up at least 1% of performance over the last week. Materials lost over a percent. Energy picked up, looks like about 3 percentage points. And obviously we know there was a big move into energy in the last week. It's still a horrible, horrible investment. It's just less horrible than it was. Staples actually outperformed. You can see they were down by, looks like 6.6% going to last week's show. Now they're only down by 3.94%, so they picked up about 2.6% of outperformance. So you are seeing rotation here, and healthcare lost some value. So notice that the dots are kind of in the middle here of all the sectors. They tend to be a little bit more on the cyclical side. So you look at industrials, materials, energy, staples, much more cyclically oriented. So that's kind of this rotation that we're talking about, and why today we'll take a look at growth versus value, because most of these also tend to kind of fall towards value type names. Not all of them, but many of them do. All right, let's now take a look. Let's go to charts. And let's first take a look at the spider. And I think I showed this last week, I'm not sure, but you'll see that we have hit this a week ago Monday. This is a monthly bar chart. So in the month of November, we actually hit the long-term target for the S&P based upon the wave count off of the March 09 low. So if we start there, and this is using Tom DeMark's way of counting. If you're an Elliott wave person, you may have different counts. This is mathematically counted based upon certain rules. So you may not, in other words, your wave 1 might have peaked here versus peaked here. And therefore, your counts aren't going to line up here. But this target has been in place since 2015 from the bottom of wave 4, and we hit it. And this is one of the reasons that I've been telling people that I'm not opposed at all to doing some selling here, which includes hedging. And you know, I've hedged some of my book myself. I've used S&P futures as the hedge as compared to spiders. They're very similar. I like futures because they trade 23 out of 24 hours a day. So even in the middle of the night, if we reach a certain level I can hedge. So I've lowered a little of my exposure in the markets here because we're up against a long-term target. Let's take a look at, we'll do the TNX next. So here's the US 10-year, and I've kind of highlighted, going back to March, that we've really been in a trading range. And once again, over the past week, you know, we got into the mid-90s. We hit our target of 94 basis points, which was our upside when we broke out. Let's see, which day was it? I think it was this day here, October 7th was the bullish breakout. And we said rates would go to 94 bips, and that's our target, and we're done with it. The count here got to a 12, so we're also very close to getting a 13 upside exhaustion signal. And so, you know, I've gone flat in the bond market. I have no particular bias. And for the time being, I kind of think like we're going to be in a trading range from, I don't know, 99 basis points all the way down. I'll give it latitude all the way down to about 65 basis points. I'm not saying we'll get that low, but I'll give it latitude all the way down there. On the upside, I realized we could extend, you know, higher and get all the way up to like 126 basis points, which was the high in March. So even though we've been in this trading range, it wouldn't surprise me to see rates go higher and kind of get into the whole price range of the day that made the high. So that went anywhere from almost 127 basis points all the way down to 100 basis points. So yeah, we could potentially extend another 25 basis points. I don't think we're going to get much higher than that over the next several months. So that's my look at bonds. And now let's take a look at long-term chart of growth versus value. So here is the, I'll take the cloud off first so you can just see. Here's the representative of IBW S&P large cap growth divided by S&P large cap value. So the fact that the chart peaked last month and is coming down says that value is outperforming, right? Because we have growth as the numerator divided by value, which is the denominator. I can flip this around and you have the exact inverse. So this means that basically since 2007, growth over time has way outperformed value, and now you're finally seeing, some correction. And the question is this temporary or is it more than temporary? And I would suggest that at a minimum, very good chances are that the peak price we saw is as much as we'll go for now, and that that value will probably outperform growth for a little bit still going forward until we start hitting some downside support targets. So the first of which would probably be the clouds baseline on the conversion line on the monthly chart. So there's still some room here, and that'll consolidate in here. So I think for now the growth versus value peak is in, and it's a question of how far it goes. But if you look at this move, and especially the huge move since fourth quarter of last year, this is about as overdone and multi-sigma standard deviation move that you should see this correct and come in further. So that would give you potentially reason to think about, if you want to buy stocks, you might want to buy value names as compared to growth names right now. So that's why I also made today's lesson doing that. So now let's switch to the value names that I've shown you before. So we're going to start with Berkshire Hathaway, which I'm pretty sure I put in here, and then so here's Berkshire. I had put just on a little bit of work on the chart here. This megaphone type of pattern, very similar to the S&P. All-time highs this week. Good chart. There's a trend line. We could even draw something along there. So even the sell-off in October pretty much held support. It comes. So it's a good-looking chart. I did connect these highs to each other, and notice that as we go forward into December, the 245-ish area is going to be both the risk level from this 13 sell signal back here, or let's just say upside exhaustion signal, as well as where the tops are. So the stock's trading 234-ish, another $10 or so from here. May not be a bad place to lighten up. Otherwise, it has a bare upside target of 261.5. First support, I would say of significance, would be into this gap zone from earlier in November. And that's that big gap is the night that the S&P opened 155 points higher. That's probably a week ago Monday when the Pfizer news came out. So back in there should be support. Let's call it the mid, 215, give or take $5. Okay, United Health. That's not United Health. That is United Health. There we go. So also all-time highs last week, strong. It's gotten through its risk levels from these 13s. So I'd look to buy a pullback. Initial support, I'd say, is 338-ish. Secondary support down here at 308. And if it's a good breakout to new all-time highs, we really shouldn't get lower than there. So that's kind of your two potential entry points as far as upside targets. I don't even see anything. Let's go to a monthly and just take a look. Monthly's on a 7 count, so in a couple months. So this should be decent through January. Beyond there, I actually don't even have an upside target. I'd have to do more work on that. Verizon we looked at recently because just by chance we looked at the communication services name. So we looked at this a few weeks ago. It's popped up. It rejected getting a sell signal here against the bearish propulsion level. Has a couple of targets just a little higher near 62.5 up to, let's say, 65. So somewhere in there, maybe some resistance. If it breaks through there, then look for upper 60s, like 69 or so as your next upside target. Johnson & Johnson. Stalling still, many of the names kind of look like this, where it's made slightly higher highs, but it never really broke out to the upside. The good thing is the sell-off just a few weeks ago bottomed right into the bearish propulsion exhaustion level, and it's come right back. So there's going to be resistance anywhere from here up to kind of 161-ish. So if you're looking to take some profits, as you get some strength here, you can. Bigger, longer-term upside target in a bull market is 181.5. Telephone, we looked at also. Much weaker name, but I had said that I like the 9 down here. I mean, I actually think Telephone is a decent name to look at, because if you kind of just look at this, you got a triple bottom. The third bottom came with a setup 9 count. We bounced from there. This name, if you're looking for a value name, Telephone is actually a name that I think is worthy of looking at. Pfizer, this name I own myself. Obviously got the good news, been selling off since, and that's a little disappointing. So I'm long down from this bottom in here, and I didn't sell. It's good news, and in hindsight, I wish I had it. It hit its TDST level, it hit its propulsion exhaustion level. It's come right back down. So I've got to think about, it's mid-range here now. I've got to think about what's going to get this to come and take out that good news is the high from when the good news came out. So I'm really not sure what I'm going to do with this now, frankly. Walmart. Making new all-time highs. Love the name, and have, despite all these 13 signals on the weekly chart, let's take a look on a monthly. This just plows to new highs. I've been long this thing for years and love its performance. And there's no real levels that even stick out as far as, okay, here's some upside targets, 185 to 187. On the downside, if let's say we got a decent correction, if this thing pulled back to 125 to 130, I'd like it there. Bank of America. Right. Better looking chart than many other in the banking sector. Nonetheless, we've stalled against the propulsion exhaustion level the last couple of weeks. Even with multiple closes beneath 24.57, none of them were qualified and confirmed, so we never got a sell signal here. It's back into the middle of the range. You're really going to have to see financials move up or interest rates move up substantially, I think, to really get financials going on the upside. Upside targets still remain something like 33.5, 34, near the all-time highs for now. And on the downside, I still want to see this stay above 25. Let's do Cisco. It's a name we haven't looked at in a long time. Same thing. I kind of like the 9 bottom. Went to the bearish propulsion exhaustion level, comes right back. You buy a little bit more on a pullback. I kind of think, similarly, that. Well, let's see. Let's just pull a little more data in. Let me see. All right, so something like that. Thing is, the sell-off here held, so we tested the lows of the year, and it came shot right back. I kind of like it. So Cisco is a value name I kind of like. That's it. We're out of time for the week. So I appreciate that you listened, and next week we'll take a look at a whole new sector, what's going on in the markets. So that's this week's show. I'm Rick Bensignor, and you've been listening to In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.